Welcome back to the Meet the Visionaries podcast, hosted by the MIT Center for Real Estate. I'm Othman.
And I'm Jainil Shah. We're Masters of Science in Real Estate Development students here at MIT.
Thanks for joining us today, David. Allow me to introduce you for our listeners. We're joined by David DesPrez, partner at Bain Capital's Special Situations team, where he leads North American real estate investments across debt and equity, including non-performing loans and complex capital solutions. Prior to Bain, David worked in distressed investing at Oaktree Capital Management and investment banking at Goldman Sachs. He's a graduate of Brown University and a frequent contributor here at MIT on navigating market dislocations. David, really appreciate you being here with us. Bain has many platforms: private equity, private credit, real estate. On a rudimentary level, what service does your special situations team at Bain especially provide that other Bain platforms do not?
Sure. So Bain Capital is a big place. We have about 215 billion of assets under management. We're most well known for our flagship corporate private equity product that was founded by Mitt Romney and several others back in the 1980s. But like other large alternative asset managers, we have branched out into other high returning, high fee private market asset classes like real estate, like special situations, our credit platform, venture capital, and then a number of sector focused specific private equity funds. The firm is unique in that we are private. We're the largest privately held alternative asset manager in the US, which we think is a unique and very differentiating factor. There are 180 of us own the firm in its entirety. We have no outside ownership of the GP. It's also unique in that we are truly aligned partners. Bain, the current and former employees of the firm, are the largest LP in every single fund that we raise. And so anywhere from 10 to 20% of every single fund that we raise is our own money. And so, we can still credibly say to our LPs and to the market, we're investing for your account and for our own, kind of the largest, most evolved version of 1990s private equity. We're also unique because, when you don't have external shareholders, you're able to grow AUM really thoughtfully. For us, it's really about returns and that alignment with our investors, which we think is really differentiating and really resonates with LPs. As it relates to our special situations franchise, about 25 billion of that 215 is in our special situations franchise. The special situations franchise has evolved pretty significantly over the last 15 years. Going back to the early 2010s, we had a business that was really our distressed debt business that dabbled in kind of capital solutions and other private market opportunities within a closed-end private drawdown private equity style fund. As the 2010s sort of continued to play out and there was less and less distressed debt opportunity, really had a lot of distressed debt during and coming out of the financial crisis, and then you had a real scarcity of high quality distressed debt opportunities. In the mid-2010s, you had commodity-related distress with coal and then E&P in the middle of the decade, but really you had a scarcity of interesting opportunities. And so we and many other peer firms evolved what was a distressed debt strategy into more of an all-weather capital solutions, special situation strategy that really focused more on private opportunities, bespoke capital solutions. And many of the opportunities we were sort of looking at weren't actually distressed in any way. They were companies that were healthy, growing, but for some reason needed capital that wasn't cleanly sort of private equity capital and wasn't cleanly, private debt. Think of special situations, which actually means different things at different firms, as kind of the hole in the donut, right? Like everyone knows what real estate is. Everyone knows what private credit is. Everyone knows what control private equity is. Special sits is the other. It's minority equity. It's structured in some form, pref or mez with warrants. It's something that has downside protection that is credit-like, but also equity convexity. And it's an asset class that is still relatively in its nascency. Most of the other large alternative peers, like I said, most of them are public, have a business line that competes with us that raises closed-end funds that addresses that part of the market, that sort of not cleanly debt, not cleanly equity, sort of in the middle, but targeting equity returns with more cash flow and less volatility than like traditional private equity. Maybe slightly lower multiple, but still seeking mid to high teens IRRs and high ones to low twos multiple of money at the fund level.
That makes a ton of sense, and that opportune kind of positioning within the capital stack. Now, I want to zoom in on the word opportunities within that other category. So by definition, special situations is a strategy that isn't run-of-the-mill. I think our audience would love to learn more about your team's deal sourcing, right? So how can you repeatedly originate a proprietary deal flow versus participate in a competitive process in such a unique strategy? And then I would also ask, Bain invests through platforms rather than one-off deals and other strategies. How does that translate to your special situations team?
Right. So special situations, the way we present it, and it is different if by peer firm, but the way we present it, there's really three sub strategies within it. There's capital solutions, which is sort of that bespoke dequity, if you will, some downside protection that's credit-like with equity, convexity. And that's the largest individual part of our business. And that's pref, mezz with warrants, minority equity, structure, some sort of structure. Then we have our asset-backed business, which is really where I spend a lot of my time, which is real estate and other asset-backed platforms. That can just be straight common equity, but the sort of more bounded equity, levered equity returns in that strategy is a fundamentally lower vol return profile than corporate private equity, for example. That's just highly levered equity. And then the third is distressed, which is more episodic and more cycle driven, and distressed is sort of a once every 7 years opportunity. COVID was the early days of COVID was the most recent example of that. Within the fund, we break down by sector, and so I lead the real estate, but now all asset-backed platforms within our business. And thematically, we look across all three of those opportunities. That's capital solutions, just straight platform or asset level equity, and distressed, and can allocate to opportunities wherever we see best relative value. Your question on platforms, we are not ourselves an operator. I think we at Bain, we do have a deep bench of what we call our portfolio group, which are post-closing, subject matter experts, some of which are focused on specific functions like, the office of the CFO or HR, others who are focused on specific sectors, and we call them our centers of excellence. We have a deep bench of 140 people who help with our portfolio companies post-closing. The real reason why we focus on platforms is typically scale, right? So we are, while the team and I certainly like to think we know a lot about development and a lot about how to drive value via leasing. We ourselves are not quite literally the boots on the ground doing those things. We are heavily involved and a very active owner, but we are typically working with partners who are very proximate to our assets geographically or within a specific asset class as it relates to real estate. A broader part of my business, which includes residential mortgages, that is more of a top-down, national type business model where we are overseeing the portfolio level, the credit, the credit box and the pricing of the underlying mortgages that we originate. And we're very actively involved in that, but we are not literally making the mortgages or underwriting the individual, granular mortgages. So we work with best-in-class partners to really drive, excellent outcomes.
Makes sense. So you mentioned something about being nimble along with the cycle, particularly in your distressed debt strategy. I want to take our audience into your business a little bit more and ask you a cycle question. In special situations deals, control comes down, capital structure, across cycles. How have current dynamics between equity partners, borrowers, and capital providers shifted, particularly around covenants, control rights, and who ultimately dictates the restructuring? What does that shift mean for David's team?
Across my career, there's really been arguably 3 cycles. The first was coming out of the GFC, where you had a a deep cycle where there was a profound lack of liquidity everywhere in the bank markets, the private markets, and that led to a really large buying opportunity of assets, both equity and in credit, like buying defaulted mortgages in CRE and even more so in the residential space. Then you had the COVID, sort of what I would call very brief heart attack recession of COVID, which led to a very acute set of mostly public market opportunities, sort of distressed in everything, REITs, CMBS, RMBS. It was the most interesting sort of tactical trading environment of my career by a significant margin, and that includes the GFC. Just given sort of the price action and the severity of it and how fast it was. Of course, the policy response was so profound that opportunity was relatively short-lived. But there were some really acute opportunities, particularly in asset classes that were really vulnerable during COVID, like hotels being the most extreme example. Hotels literally went from being open to being mothballed and having negative cash flow. Right. There was real opportunities in hotel. There was also opportunities in retail. Think like physical retail was closed during COVID, and it was also sort of a mass e-commerce adoption event. And so you had really really kind of existential questions about various retail formats during COVID that led to some pretty severe price action. But overall, the COVID recession was kind of like a heart attack, and then the patient was resuscitated within, call it 6 to 9 months. And then I would say, the cycle that we're still living in is the post rate hike. The Fed started to raise rates right around the Q1 2022, and you saw that really begin to flow through to asset prices late in Q2 of 22. And since then, you've had a pretty nasty re-rating of particularly commercial real estate assets. Cap rates are up, basically across every asset class. That has been most severe in the tightest absolute cap rate asset classes. So things like multifamily, SFR, industrial, the re-rate from a 4 handle to a 6 is a nasty re-rate. That's like a software company re-rating from 30 times earnings to 18 times earnings, which is something we're seeing right now in a different market. And so you've had a sort of slow moving price reset, and all the while you've had decent income growth as a function of a pretty benign economy, up until this point, and inflation, which has led to sort of nominal NOI growth. And so you've had, I would say, in a supportive lending environment overall, where you've had a pretty orderly deleveraging of the system. With that sort of re-rating, you would have expected, a deluge of distressed debt opportunities like you had during the GFC. We didn't see that. What you saw was a lot of amend and extend. Some people refer to it as amend and pretend. But what you really saw was kind of capital structures right-sized just over time, right? Lenders were generally accommodative, and with the exception of office, really, where you had some real impairment, and derivatives of office like life sciences, or you've had some real impairment. For the most part, you've had kind of this orderly deleveraging, like the multifamily asset that was bought at a 4.5 cap in 2021, that then was probably realistically worth 5.75 to 6 by 2023. You also had 30% income growth in that asset from 21 through today. And so with that, you probably went up to 90% LTV, but you've probably gotten back down to the mid 70s, and maybe you're on the verge of a cash neutral refi at this point. And so that debt is not going to trade at some discount to par, right? That said, there's been episodic opportunities. We are at Bain, in my business, one of the largest buyers of CRE NPLs. We've found some sort of idiosyncratic opportunities. One in particular in New York, we bought a big portfolio last year that has been a good position for us. So there's always opportunity in a $5 trillion market. But overall, it's been this very orderly deleveraging in this cycle.
And the control rights, covenants, and how are those done?
Yeah. So the answer is probably not as much as they should have. Commercial real estate debt That 5 trillion number I mentioned is that's total commercial real estate debt. That includes agency for multifamily and every other form of debt. So CMBS, bank, insurance, debt funds, et cetera. Banks have pulled back since COVID for things like hotels and retail, and really since the 2023 regional bank crisis with SVP and First Republic. They are coming back into the market. Banks are about 70% of transaction count and about 50% of transaction dollars. So there's a very significant player in the market, and sort of what they're doing or not with has a significant impact on liquidity. But you've also had a lot of influx of liquidity. So you've had a lot of insurance money. That's a huge trend in our industry, and alternative asset management is raising more and more insurance money. You've seen a lot of insurance money and that gets good treatment for commercial real estate loans come into the space. You've also had a lot of formation of capital around debt funds. And in the post-rate hike period where you had a lack of things to do in equity, you've had a lot of real estate equity people kind of showing up at debt conferences trying to do debt deals because it was a more interesting relative value than equity. So all of that is to say you've had a decent amount of capital kind of come into the market. And so when you have that supply of capital, sort of on the sidelines, competing for not a ton of transaction volume, frankly, because most borrowers were just amending and extending or amending and pretending with their existing existing lenders. Right. Both cost of capital and your docs are a function of supply and demand for that capital. And there's been a decent amount of supply of that capital. And so, you would have thought that, oh, wow, like banks are like really going to tighten the belt and everyone's like really like that actually hasn't, it's happened less than you would think. I would say that, with those amend and extend deals, like with your incumbent lender, those deals in 2022 were pretty borrower friendly. I'd say over time, those became more and more lender friendly, including, real milestones, maybe some fees, maybe a contractual mandatory pay down, right? That was mostly with your incumbent lender. On new business, I'd say the market remains pretty competitively bid.
David, shifting gears from sourcing now to execution, Bain has a strong operational DNA. When you step into a distressed real estate situation, how often does value creation come from operational intervention versus financial restructuring?
No, it's a great question. One, I'd like to level set and just state that, distress is a minority of what we do. It is certainly within our toolkit and something where we think, we can add a lot of value both on the buy as well as in our understanding of both the in and out of court process and to your point, operationally post-closing. That operational comment though could be true in a non-distress scenario, right? So maybe there's two ways to answer that question. The first is, we're very focused and very thematic. So when we make an equity play in commercial real estate, it's generally, deeply thematic and the result of, first sort of white papering the idea, going very, very deep on supply and demand and specifically how we want to address that thesis and making sure that it's a scalable idea, canvas the market, meet, basically explore every possible way that we could express our view. Could we express it in the public markets? Could we express it in via development? Could we express it via buying existing buildings? Could we play it in the debt market, right? And so we're always asking what's the right entry point if we have that idea? And so one is the amount of, just background work that we do. And the second is, you have to do it with good people, right? The level of, how much of that execution happens at Bain with our portfolio group people or even just the investment, deal team versus how much happens at an external partner varies deal by deal. But regardless of the answer, we're a very active owner, right? And very involved. And we do believe, as is the case in our corporate private equity business, that we add that our operational sort of chops and focus on operations as opposed to just financial leverage is unique.
Great, thank you. And staying on execution for a minute, but now looking specifically at your platform approach, when you invest through platforms rather than single asset deals, how does that change your underwriting lens? Are you primarily writing the asset base or the management team and the scalability of the platform?
It depends. We underwrite any addition or sale from the portfolio. We think about from a pretty rigorous bottoms up perspective, but we also take a very, a top down, a very, what I would say, rigorous and ruthless top down approach of when we have an idea, right? Like, for example, we've invested in cold storage real estate in a large way, or in the past we invested in infill industrial real estate. When we have an idea, we develop the idea. We then say, we want to target X dollars, and that's a function of the opportunity set, what we think is achievable, also the size of our funds and what percentage of our fund we want to make that position. We then go start executing on it. We make add-ons within a strategy. But we, I would say quarterly, ask ourselves, does this strategy still hold? Just because cold storage was interesting in 2022 does not mean that definitionally we should do the next deal. We should do the next deal if it still makes sense in 2025. When you have platforms, it gives you a sourcing advantage. I mean, like, volume begets more volume, and that is helpful. It's helpful from a financing perspective to have scale. It's helpful with tenants, and depends on the sector, but it can be helpful with tenants. So look, the larger you get, there are some synergies of having an existing strategy and adding on to it versus doing something new, but we are, underwriting each individual deal.
And I know we briefly spoke about New York earlier, so maybe coming back to New York and looking at a tangible example. So in markets like New York, where assets have been impaired for years, how do you determine whether a property is temporarily miscapitalized versus fundamentally obsolete? What ultimately determines whether you lean in or just walk away?
New York has, we like the demographic story in New York. It's really supply constrained. There's other, policy driven headwinds to additional development. And so, New York across a lot of asset classes has some of the best, in our view, rent growth trajectory anywhere in the country. Your question kind of hints at office. New York is the largest office market, but it is one of many office markets in the U.S. I think we've been pretty cautious about office. I think our view has been that office was not only oversupplied in a lot of markets prior to COVID, but we believe that there's a real consolidation going on in office, and the absolute best assets are attracting the absolute best companies. And we think the market is pretty efficient. Like, it's saying something pretty clear, which is that, the very best office corridors in New York, that would be Park Avenue and Hudson Yards right now, are doing really well. Rent growth is great. Occupancy is at historic lows. New leasing is great. But, mid-block B office, commodity office is in a really bad place. And it's really, really hard to take a view on that. I think, I'm not smart enough to know the impact of AI on office usage, but in the absence of conviction, you're not seeing us do much there. What you have seen us do is finance office, but our view has pretty quickly been that the market is pretty efficient for the best assets and pretty broken for anything other than the best assets, and we just haven't found conviction in that other bucket, and so you haven't seen us do much.
Understood. If I may, try a bit more on a broader backdrop. So looking across, I know we spoke about office, but looking across hospitality, multifamily, and industrial, where do you believe capital is currently over-penalizing risk, and where might the next wave of opportunity emerge?
So I think the capital markets are saying something pretty clear, which is it's sort of the top decile is attracting capital. The bottom 9 deciles are really struggling, and we've found it hard to pick a fight with that view. In multi, our view is that the capital formation got ahead of the opportunity set, and so that makes it doesn't mean it's impossible. Multi is a huge space, so there's certainly exceptions to this comment, and exceptions in our portfolio. Broadly speaking, there's a lot of both debt and equity capital available for multi, and that is softening the blow of what are some actually pretty tough multifamily fundamentals, particularly across the Sun Belt right now. Multi is as oversupplied, particularly high-rise, luxury 1 and 2 bedroom product is as oversupplied as it's ever been. If you look at the charts of it, it almost looks like the GFC. It's just that the capital markets are single family housing on the eve of the GFC. But it's being absorbed pretty well. Like I think those developers were right about demand. They were just early and too much. And so it's absorbing, albeit with like pretty significant concessions. But occupancy is still, is below cycle, sort of below mid cycle. And it's going to take several years to kind of grow into that. So, but there's a lot of capital, and our view is that's mostly being absorbed by the market. We've seen some capital solutions in multifamily. Those are cases where sponsor is over levered and needs to pay down debt or needs to recap their LP. We've seen some interesting kind of prefy type deals, but our general view is that both the debt and equity capital markets are pretty well bid for multi. For industrial, our view is that industrial probably has both the best fundamentals and maybe the best capital markets too. So the market's, in our view, kind of efficient and right, if you will. The industrial demand is almost every signal we see is pretty positive, with increased supply chain resiliency and a focus on more domestic redundancy. All of those are massive green lights for industrial in the U.S. And we both see that and are playing that, primarily through our temperature control strategy, but are seeing capital markets be pretty efficient for industrial. And so there's no distress. There's not really much in the way of capital solutions. It's more of do you believe the consensus view, and can you make that equity underwrite pencil? For what was the last one? Hotel.
Yes.
So hotel is probably the most interesting in that it's the sector where you have the widest dispersion of views amongst smart people. The hotel equity capital markets are saying different things than the public and private markets. The public markets are not very constructive on the hotel REITs right now. They're trading at between high sevens to a 10 cap across the board, which is cheap to where hotels are trading in the private markets. Although most of those trades have been of higher quality. The debt markets for hotels were extremely soft, and we've been playing that. We had a partnership to do just that, sort of coming out of COVID and then exacerbated by the regional bank crisis. We saw a real lack of liquidity in hotel credit, and so from 23 through through today, we're actually funding a deal next week in that strategy. We've been a provider of liquidity, of debt liquidity in hotels. But overall, I think today the capital markets are very mixed in hotel, and I think there's real opportunity there.
Mm-hmm. If I may just add one more quick asset class here of senior living, if you could really shed some light there.
Yeah. So, and this is a strategy that we've been in and out of in our equity business. Senior living took a beating during COVID because you had negative demand trends. However, you have the most obvious demand story that you could possibly come up with in real estate, which is just simple, demographic cohort analysis. And America is getting older, right? Mm-hmm. And the octogenarian, meaning 80 plus population is growing, and that insight that's not a blinding insight. That's just gravitational, right? And so our view is that you're going to see more. You're going to see a lot of demand growth in that space. How to play that. Operating those businesses is actually very complex. It's regulatory, whether it's private versus government pay. What we have been is a landlord partnering with operators. We like that space. I think the market also has bounced back really quickly, right? If you look at the best performing REITs of the last since the rate hike have been senior living REITs, right? It's been healthcare REITs, and so the market is also is in sympathy with that view. So finding deals that work for a mid-teens cost of capital is not the easiest thing right now, but the demand signals are positive, and the debt capital markets treat senior living as a kind of multi-derivative and are pretty constructive for that product right now.
So, David, deals hinge on information advantages, right? And beyond the headline appraisals as a deal maker, can you tell our audience how you obtain an informational advantage particularly around asset level insights, legal positionings, stakeholder dynamics, and if you could also kind of just shed light on the distress work you do as well.
Sure. So, certainly in the private markets that you can have informational, advantage. I'd say that the first thing, and it's in the age of AI, I know this might sound antiquated, but deep thematic work and, really devoting 1,000 hours of your time to developing a view on cold storage, or there's an area of retail where we're working on something like that right now. There's no replacement for that, right? Because with that sort of deep thematic work comes conviction and relationship building and ultimately access, right? The better the asset, the larger the portfolio, the more sophisticated the counterparty, the less likely it is that you're going to make a ton of money on the buy, just really, getting the better of your counterparty, right? Like most deals worth doing are, won or lost between the 40-yard lines because you're dealing with a counterparty who knows what they're doing. Where you really win is by having a real conviction and a thematic view, and putting that on at scale, and then also having the operational backup to execute on it. And so I know it's an old-fashioned answer, but there really is no replacement for that type of like deep immersive thematic view. And for example, in retail right now, there's a senior member of my team who spent 80% of his time for the last 2 years. So that, I don't know what that is, thousands of hours developing conviction, the idea, all of the requisite industry relationships. And, if and when we do what we're hoping to do, that will be a result of that really concentrated set of work. Real estate's a very local business. A lot of insight and information asymmetry is MSA driven, or more often not even hyper local, right? Like this family has owned this building that's decrepit for 3 generations, but now there's some estate planning and that asset's going to sell for the first time in 50 years, right? And you typically know that if you own the building next door, right? So there's, and you typically don't know that unless you do know the building, unless you don't know the building next door. So there's a lot of very local knowledge in real estate, and we also, I think, have the humility to know what we don't know, which is part of why we work with local partners, right? Because from behind a desk in Boston, you don't always know all those things, right?
Thank you. That was informative. Looking through the macro lens, there's been talk about private credit as a potential canary in the coal mine for broader financial stress, and we're reading about blue chip funds locking up redemptions. From where you sit, are you seeing these as alarming fault lines? And if so, how do these dynamics translate into real estate special situations rather than just mark-to-market volatility?
So, we have a corporate private credit business at Bain. I think we're better positioned than most. Our view is that there is a concentration of high multiple software businesses, which might be decent businesses, but where you're having a kind of a fundamental valuation reset, not unlike what happened in real estate, right, in 22, 23, 24, in some of those sectors, right? Like if you re-rate from 25 times earnings to 15 times earnings, that's what that implies for your LTV on that private credit loan, looks a lot like, re-rating from a 4 cap to a 6 cap, right? So you're going to work through that sort of stress. I think our general view is that there's nothing like systemic about private credit, right? It's outside of the banking system. Yes, the banks provide back leverage to a lot of private credit lenders, but predominantly it's outside of the banking system. So losses, if there are some, would be localized to those fund investors. It is a strategy in an investor's portfolio. It is still a single to low double digit strategy in an investor's portfolio. The equity markets have had a pretty good run, right? And corporate credit spreads are still at pretty tight historical levels. So I think the market, at least so far, is saying this is an absorbable shock. we talked earlier about the sort of amend and extend and the pretty orderly deleveraging of real estate assets. I don't spend my time looking at SaaS, so I am not going to give you a prediction on the future of SaaS EBITDA or what AI means for that space, because that's beyond the scope of what I focus on. But the question that I think I would reasonably have, that anyone could reasonably have, is you have a pretty liquid credit market between the public markets, the bank market. Bank balance sheets are in a very healthy place, especially the big banks. Why would some of that risk not get absorbed in the same way that some of the sort of extensions, allowing companies to grow out of that, being over levered? That's an entirely plausible outcome to me. So long-winded way of saying we don't see any systemic risk to it. And there's really not, if anything, real estate and residential real estate has been a beneficiary in that, corporate credit spreads have been tighter than asset-backed credit spreads. And you've seen some rotation of credit into asset-backed from corporate as a result of some of the concerns that people have.
So thank you so much. We have a final two questions for you. So in a recent Hotel Investment Today interview, you talked about a material liquidity gap created by the pullback of traditional lenders. When you see that imbalance, how do you decide where to play in the capital stack? Is that senior debt, preferred equity, or pursuing for control? What factors ultimately drive that decision?
The constraints we have, we're generally looking for the best unit of risk that we can find in a capital structure, the most attractively priced unit of risk. With the constraint that, it depends on what bucket of capital we're investing in, but the flagship special situations fund seeks mid-teens return. So even if we found a great, 9% returning opportunity, we probably wouldn't put that in that fund. So we have an absolute constraint or hurdle. Given that constraint, we're looking for the best absolute levered return profile. Sometimes that is, like it was in the hotel debt instance that you referenced, sometimes that is, taking a first lien mortgage and back levering it to a mid-teens return at what we think is, 60s to 70s LTV. Sometimes that is taking equity risk, as we've done in cold storage or in retail or in dry industrial in the past. So it depends on the situation, but we're looking for that best risk-adjusted return that we can find.
Yep. And then for our last question, so special situations investing requires acting decisively with most of the times incomplete information. How do you distinguish between a truly contrarian view and one that's just early? How do you build conviction before the market catches up?
So that's true sometimes, right? When in distress situations, oftentimes you have a lack of information, but pricing that could merit making a decision decisively, as you say, in the absence of information. That's really in our business only acute to distressed, right? Where you may have a lack of information and the market could efficiently price the fact that any buyer of that instrument has a lack of information. When you get into private special sets, sometimes being in the capital structure already or just having access can drive an unfair advantage and excess return. Not always, though. And I would say that the private markets, both for debt and equity, are large, and most of the companies we work with are sophisticated. So we're competing on capital. We're also competing on partnership. What we bring to the table post closing, certainty of execution and close. Where we can, we are certainly trying to win with excess return on those non-monetary factors. But we're not naive to the fact that the economic terms matter too, and so that requires in certain investments taking a positive equity view and thinking obviously we usually have structure in our deals, but really believing in that upside and not just focusing only on downside.
David, thank you again for sharing your perspectives so candidly. This was an incredibly thoughtful and technical discussion, and we are grateful for your time. And to our listeners, thank you for tuning in. I'm Jainil Shah, and this has been the Meet the Visionaries podcast, hosted by MIT Center for Real Estate. We'll see you next time.
Thank you for having me.